And our guest this week is Ian Lance from Temple Bar, which has been having a great run. So even though we talked to them relatively recently, I think there's still quite a lot to catch up on. Sorry, without further ado, these are the three things that I picked out from this week's news stories to talk about. They're all actually linked to results. This is sort of results season at the moment. We've got an endless stream of people reporting year ends for the end of December. And among those, Octopus Renewables, Fidelity Japan, and Pershing Square are the three that I thought I would have a look at. Octopus Renewables first. It's a relatively new fund, as you can see there. And the NAV has started to decline now, as you can see at the end, towards the end of this chart. It's traded at a premium for most of its life, which has obviously helped it expand, and it's actually quite a decent size now. So the returns are actually pretty good, although it was on a very big premium, and that's could have come back a bit. So shareholder return for 2021 was just 1.6%. You can see the returns since launch there, so they're not too bad at all. It's meeting its dividend targets, and we've got a 4.8% increase for 2022 penciled in. And then that's actually quite well covered by earnings, as you can see there. It's been spending the money, it's been hovering up. So spent almost over £400 million in 2021. And all the cash that he has got at the moment is committed to things that are under construction or sort of deals that it's done already where there's some kind of conditional consideration. So I think it is possible that we might see it coming back for more money relatively soon. This is what its portfolio looks like. So actually, it is a sort of pan-European portfolio, North and South Europe. And it's an interesting mix of things, really. So solar, wind, and that sort of diversification angle is something that a few trusts have kind of focused on. So you've got there in the corner there the split of assets by country. And as you can see there, it is actually quite well diversified now. Coming on to this now, this is an interesting chart that you'll find sort of buried into a lot of kind of annual reports and things, but this is just showing you how sensitive the NAV is to various different factors. And a big one that affected ORIT in 2021 was higher energy prices. So these added well over £30 million to the valuation. And it's interesting that they've seen a very big shift in some markets. So obviously we know power prices have gone crazy here in the UK, but one of the biggest jumps was actually in Sweden. Not because the Swedish power prices needed to go up, because they're actually a lot of their power comes from hydroelectric, but actually they've got an interconnector with Germany. And so if you can export through that interconnector, you can actually lock in some quite much higher prices. So that's driven the prices up for the whole of the Swedish market. I say the whole, well, I say not the whole, but not quite the whole, because actually it turns out that it's much better if you're in the bottom half of the country than the top half. That situation, I think, is going to change relatively soon as they upgrade those lines. One thing to note there at the bottom, and this sort of highlights something that we've got across the whole of the sector, is that the people's assumptions of what should go into the NAV do vary. And I picked up that they are assuming that UK corporation tax, which is jumped from 19 to 25%, is going to drop back again after 3 years. I think that's unlikely. But they're saying there that even if that wasn't the case, the actual hit to the NAVs and that isn't too bad. They have got a thing there for FX as well. And for these European funds, the funds that got European exposure, the fall in the value of the euro versus the pound has actually been quite material last year. And that's something to watch out for across the whole range of different investments. This is the picture of how its power prices are factored into its NAV. And you can see there that it's assuming kind of an average price of £57.50 for the next 3 years. That, I think, might be an understatement, as we know that power prices are well over 100 now. And it just depends on how fast they come back again, and what happens with Ukraine and that sort of thing. But the longer term outlook is for much lower prices. I suppose that's something that we've all got to factor into the back of our minds when we're paying our power bills now, is that the most industry professionals think the power prices are coming down, and down a lot lower than they were even before they started. So that's just the optimistic picture. That obviously is factored into the NAVs too. But where we had a sort of run of NEVs falling across the sector because of lower forecast power prices, this number going down. Now, at the moment, trends needs to be going the other way, mainly because of this number going up. So we'll see how that balances out in the future. This chart here just shows how sensitive the numbers are to shifts in power prices. And you can see that the green bars are actually not that material, really, for quite a long time. And that is because they've got a fair chunk of subsidies coming from UK, Ireland, France, and Poland. But it is interesting that there is quite a big variation across the whole of Europe. So the assets they've got in Finland and Sweden and Spain, that are under construction loan in Spain, they don't attract subsidy. And so therefore it is all about what power price you can get. What they've been trying to do with some of their projects is sell power under long-term power purchase agreements. And that is the sort of blue line here, or blue bar here. And that, I think, is the sort of thing that a lot of other renewable energy generation companies are going to be doing. They'll be trying to fix more of their power sales for longer periods. So we'll see how that works out in the future. But that's quite a long time that they've managed to get those PPAs for. And that's obviously quite good news. It's the sort of thing you don't really see in UK and Europe, but you do see much more of in the US. And it's something that I think might change, and we might see much more of this long-term fixed power price sales. One thing that they've got that I think is interesting is that they've got this facility within their sort of investment remit to invest in developers as well as in assets. Not material, but they've taken a 12% stake, 7.5 million euros in Simply Blue, which is developing offshore floating wind. I think this could be really quite exciting, but it's one of these things that it's still very early stage. So the UK is targeting a gigawatt of power coming from floating offshore wind by 2030. I think if it works, it'll be a lot better than that, a lot faster than that. But we'll have to wait and see. There are bids, we think, have gone into this round of subsidies now. There's like an auction of subsidies going on in the UK at the moment. And we think bids for floating wind have gone into that. So we could start to see some projects being developed. Whether Simply Blue ends up being a winner in all this, we don't know, but they have got quite big backers and people like Total and Shell. And so we'll just have to wait and see what happens. That's enough Octopus. Then Fidelity Japan, just very briefly on this. The interesting thing in their results was that they are actually planning to increase the amount they've got in unlisteds. So that's quite unusual, actually, for Japanese funds. As far as we could work out, the only other fund with any kind of unlisted exposure in Japan is Fidelity Japan, and that was just 2.3% of its portfolio. So taking the maximum permitted up from 10% to 20% is quite a significant change. They've got about 5% at the moment. They did have that at the end of December. They've had some success with this. So there's a couple of IPOs that happened last year. It was a very buoyant market for IPOs in Japan last year. They actually had more than we did in London. But having said all of that, the Japanese market is not very good at developing these companies, a bit the way that we are too, I suppose. So they want to, the government actually wants to encourage more kind of entrepreneurial companies, so that there's going to be more of these IPO candidates created, and getting in early, I suppose, is a good way of doing this. It's something that Fidelity did quite successfully in China as well, if you remember. So I think this is actually quite interesting and a real differentiator for this fund. So we'll just have to wait and see what happens. The only thing is that they're a bit bad at telling you what they've got invested. Really, you have to go really hunting around. And basically, the only time we've got a full portfolio listing is at the end of the year. And they haven't published any report for this year yet, just under the results statement. So we still don't know exactly what those 6 unlisted companies are, which is a bit frustrating. And we've seen a number of funds publishing their full portfolio on a regular basis. So Bailey Gifford funds, for instance, do that every month. I don't think there's a really good reason why more of them can't do that. Pershing Square, this I think is something I hold, to be fair. I think it's actually a really interesting fund. Its performance record is great, as you can see there. It had a sort of a little bit of a dive in January, but it's bounced back since then. So actually year to date, NAV terms, it's up 0.5. I think just in price terms, maybe down slightly. And as happened before, as happened in 2020, if you remember, they had a big win with a derivative contract that they had that paid out when the market fell. They've had a similar kind of experience this year. So even though the value of my portfolio fell, the hedging kicked in, and they crystallized those trades, so they actually sold out of things. And the net of that is this: it's moved into the North American sector, which I think is quite important. And as you can see here, in terms of 5-year numbers, it's way ahead of everything else. And that to me just makes it quite sort of an interesting, exciting company. And it's quite consistently good as well, which is obviously helpful. Here's the portfolio. It's very concentrated, obviously. It's all in US companies, big US companies, with the exception of PSH, which is Pershing Square Tontine Holdings, which is a SPAC that it tried to do that didn't quite work. Most recent thing it's done is buy Netflix. So the options that it had that made a sort of decent profit in January were sold, and the money was used to buy about just over $1 billion worth of Netflix, which obviously has had a bit of a dive. So they bought them down here, and that was the share price, the jump that happened after they said they'd announced that they'd taken the stake. It's fallen back a bit since, but Bill Ackman's quite enthusiastic about the whole idea. So it is big US companies. One of the things he said that was interesting, I thought, is that he thinks with what's going on in the world, that American investors are becoming increasingly US centric. And he's sort of basically saying, it's all getting a bit complicated for US investors to think about investing outside the US. So there might be a bit of kind of retrenchment going on. Whether that actually is true or not, I don't know. But it's just an interesting observation. Some of this is funded with gearing. So it was about 21% geared at the year end, which is obviously going to make it more volatile, you'd think. But he has actually been rebuilding this portfolio of swaptions, which is basically it's a hedge against the big shifts in the yield curve, I think. So that will hopefully protect it if we have another downward leg again, but we'll see. Now, the fund itself, and this is why I bought it and why I think it's interesting, is on a huge discount. So, because this is a very big fund, we are talking about $2.8 billion worth of value that is in the NAV and not reflected in the share price. It didn't do any buybacks in 2021. Basically, it's a sort of attitude of we think we've got a better idea. We're going to invest in the portfolio rather than do buybacks. Slightly unhelpfully, I think the managers have decided that they're going to focus on running the fund, and we know we'll meet investors. So you get to talk to investor relations people, but not to the managers anymore. All of that is not particularly helpful, but they are hoping that the performance and the LSE listing, which was all relatively recent main market listing, that's actually going to help bring the discount down. That's what I hope. They've also introduced a new dividend policy, which is not sort of amazing, but at least sort of 1% of NAV gives you something, and that's a sort of upward only dividend. So that I think will help a little bit, perhaps. Now, one of the other things that counts against it is these enormous performance fees, and it is obviously, I mean, it's just come out of the hedge fund sector. They wanted to be in North America because they were not really a hedge fund, and that's true. They don't actually have an awful lot of short positions in stocks. They do have these hedges on things like indices and bonds and things. But the performance fee, they take 16% of the gains. And a fund as big as this, we are talking about huge amounts of money. So portfolio return 32%, the performance fee is 5% therefore, which gave you a net return 26.9, which is just behind the S&P 500. So it would have been ahead of it without performance fees. And 45 staff in the back end of the annual report shared $443 million, which is enormous. That money, some of it is being reinvested in the fund, and I think that's maybe the only encouraging thing. And one of the things that I think is that with this enormous discount, if that doesn't close, we might actually see a kind of take private deal at some point. It's happened to other hedge funds. So they just get fed up with investors moaning about stuff to them. So they say, well, sorry, we're going to buy back the whole company. And that would give you the sort of big uplift that we've been waiting for. And as I said before, that the uplift to the current NAV is 46%, so not too bad. There we go. That's all I wanted to say on this now. Now, let's just see. No, I'm afraid we do not have Ajman Hattie. So hopefully we'll talk to him next week. But let's just go straight over to Ian, slightly earlier than Build.